Hi, and welcome to this video. I have Rick Rule with me once again. Rick, how are you doing?
Very well, sir. The better for being able to talk with you again. Thank you.
We were talking beforehand, and I want to put a poll out to the audience. Rick is going to be a regular guest, like once a month or so, on this channel. And I want to know, should this section be called the Golden Rule? Or do you have any other suggestions?
Other suggestions, Mike, not including fool, tool, or drool.
Excellent. We were just talking about, I just came back from speaking at a conference in Nassau, a mastermind group called The Collective. And it was all very high net worth people. And it was a real estate crowd, cash flowing real estate. And you started telling me a story of your real estate. But one of the things that there were a few people in that crowd that had suffered tremendously during the 2008 crisis and lost a bunch of real estate. And there is, in those times, that period of time, there was a real reverse correlation between gold and real estate. So anyway, tell us your little bit of your real estate background, because you've got quite a background. Oh, before we get to that, when was the first time we met? Was that like 2004 or 5? Did you go to Gold Rush 21, or did we meet at a silver summit, or do you remember?
I think that we may have been introduced by Robert Kiyosaki. But I can't swear to that, to be honest with you. Now that I'm in my 70s, things which happened 20 or 30 years ago are remembered with somewhat less precision, Mike.
Yes, but we met back in 2004 or 5. So,
I think that's right. I remember driving up to your studio in Santa Monica, having a great discussion. I remember after we were done recording, you and I had the good fortune to just sit and talk to each other for 30
That would have been 2010, I think.
Okay.
We flew you out there to interview you for Hidden Secrets of Money.
Right. It was wonderful.
Yeah. So, okay. So to your real estate investing in the 90s.
Yeah, I guess my history in real estate goes back a little further. When I was age 16, I read a book. I believe the author's name was Nickerson, about how to make a fortune in real estate in your spare time, which at age 16 sounded like a good idea. I had lots of spare time and no money. Of course, I wasn't able to pursue his strategy for some time. My mother, however, a single mother who later remarried, had the very good sense to invest whatever spare funds she could ever scrape up into single family rentals. Her theory being that her costs were fixed with a fixed 30-year mortgage, while her rents escalated over time. Mm-hmm. And the delta between her return on capital employed and her cost of capital, she wouldn't have said it that way, but that the delta would provide some security for her. And after 30 years, that piece of real estate would in fact be her retirement. It didn't occur to her that the price might go up too. My own career in real estate investing began in my very early 20s, I think 21 years of age or maybe 20 years of age in Vancouver, British Columbia, where using the same idea, I bought a triplex, living in the basement myself and renting out the 2 upper floors, thinking very similarly to my mom that I could raise rents over time while my cost of capital stayed fixed, while also having a bachelor apartment for free as a place to live. And if my memory serves me well, I was able to buy 4 or 5 duplexes or triplexes in my 20s in Vancouver, British Columbia, which worked well. I learned that there were other ways to make a living that were better for me. I didn't add value in real estate. I wasn't a good plumber. I wasn't a good carpenter. I wasn't good at that sort of thing where you buy properties, fix them up, change the rents, that kind of stuff. I wasn't a value-added real estate investor. I was a passive real estate investor. And hence, I stayed out of the real estate market, with the exception of timberland, really until the early part of the decade of the 90s. In the early part of the decade of the 90s, having experienced the volatility and cyclicality of mining and oil and gas, I decided that I'd get some money out of harm's way. And I invested as a limited partner with three different private family office sponsors. And my criterion, not knowing very much about anything, was no development, because I didn't want to take any development risk. I would only participate in syndicates that bought stuff that had been built. The second criterion for me, which, by the way, the general partners took on to very, very, very well, was my suggestion that I would only buy or participate in properties in capital cities, preferably in the South. The idea being that the only business that I knew that only grew, never shrank, was government. And while I don't approve of that, I didn't want to let my morals in that regard get in the way of my pocket. And that, because I didn't have the ability to understand turnaround stories, that I wouldn't buy C or B class properties, but only A class properties. That idea worked a lot better than I thought it might, Mike. The properties in Florida, properties in Texas, properties in North Carolina, in the capital cities did extraordinarily well. I think partly because of demographics, but probably also because my cost of capital didn't, in fact, stay the same. It continued to decrease as interest rates went down. The first thing we did was finance out, which is to say we had all of our cash back, but we still got the advantage of depreciation on the property while the rents went up. In about 2019, 2020, it became fairly clear to me. Hold on while I turn this off.
Okay.
It became fairly clear to me that the wind was not in my sails as a passive real estate investor anymore, simply because the interest rate cycle was turning. And I was able, by the way, again, in conjunction with the general partners who had the same sense, I liquidated that portfolio too early, as it seems now. But the truth is, I sort of believed two things. The buildings that had been brand new in 1990, 1991, 1992 were no longer brand new. And I didn't know enough about how to know how to value them. And it was very clear to me that interest rates were not going to continue to decline. So for me, the reasons that I owned those investments had changed, and I decided to liquidate the investments. But it was a wonderful, wonderful experience, Mike, particularly because I didn't have to do anything. I just had to have the guts to write the check.
Yeah. You said just now that you were early. And this is something, at least for me, I'm always too early on things. But if you're patient and you wait, they come about. So, is that the same throughout your lifetime, pretty much?
Well, I was late once. The decade of the 70s was a wonderful bull market in resources. I profited mightily. I didn't understand that markets work. I was too late, which meant that at the end of the decade of the 70s, the beginning of the decade of the 80s, I went from being a very wealthy man to having a negative net worth. I decided not to be late again for reasons that you can understand. I'm reminded of that wonderful quote by Bernard Baruch, who said that the only guy who ever bought at the bottom and sold at the top was a liar. It didn't happen.
Right.
Given that it never happened to me, I'd prefer to believe that other people couldn't do it either.
Yeah, he also, there's a quote in the beginning of my first book, I think, predicting the future is never easy, especially when you try to do it in advance. That's Bernard Baruch as well. So, being, do you know Jim Sinclair? FinancialSense.com.
I think the operative phrase now is new.
I'm sorry, Jim Paplava. financialsense.
Jim Rickards, of course. He used to live in San Diego. Knew him years ago.
Yes.
Know his son. Yes, absolutely.
Yeah, I sort of tripped across his blogs and writings, and he had a podcast back in, I think, like 2004 or something like that. And I had already purchased some gold in 2002 when it was $315 an ounce. I purchased my first tube of Gold Eagles, and I kept on purchasing ever since. And I went down to see him back then, before I had started GoldSilver.com or my own YouTube channel. But he wrote a series, and one of the things he said is that when you discover a new bull market, one of the hardest things there is to ride that bull all the way to the finish. It always wants to buck you off of its back and give you a reason to sell. And so when I saw the Dow Gold ratio, gold real estate ratio, all of the different ratio charts, that's when I decided, wow, there is a super cycle going on, and I'm going to ride this bull until the completion of this market. Have you got any comments on that?
Yeah, because I still psychologically bear the scars of seeing my net worth as a very young man go from being really extraordinary relative to my age to being sub-zero. I'm willing to be bucked off, at least the speculative part of my investments, very early. Now, I need to say, Mike, and I think we covered this in the last discussion that we had. For me, at present at least, my bullion holdings aren't investments. They represent wealth and insurance. I have, from time to time, trading positions in gold, although, to be honest with you, I'm not particularly good at it. I regard gold as good liquidity. And as I said the last time we talked, although I have a fair bit of it, I sort of hope it doesn't go up. The set of circumstances around a dramatic increase in the gold price is fairly hard on people's lifestyle. As people get sold,
and on our freedom and the whole political system.
Yep.
That's what I'm afraid of. I'm fairly confident we're going to see gold at multiples of where it is now, but at what price for society?
Right. So people like you and me, at least, our lifestyles, as people can see by our backdrops, are pretty good. Mm-hmm. And if my gold didn't go up in price and my lifestyle didn't change, I'd be happy about that. It's interesting too, Mike, when I look at the comments around our interviews, and people who own gold for a different reason say, well, the price hasn't gone anywhere. And that reflects a recency bias. If you look back, as an example, to the year 2000, gold was at $256. Now gold is flirting with $2,000. That's my kind of motionless market. It has done very well. It hasn't reflected very many people's time preference. But again, from my point of view, the essence of a good investment is one where time is on your side, where time does well. Compounding is what made me, a complete novice in real estate, do extraordinarily well. It wasn't like I bought something for $1 million and immediately sold it for $1,275,000 or something like that. That isn't what happened. What happened was that I owned it long enough that inflation raised the cost of somebody being able to compete with me. The rents increased. The cost of capital stayed steady, in fact, decreased. It was time that made me seem smart as a real estate investor. And I'm afraid it's going to be time that makes me seem smart as a bullion holder. Certainly in the rest of my portfolio around conventional financial services. As an example, owning an insurance company or a bank that serves its business well, time, that compounding is what makes you wealthy. With oil stocks, time is what makes you money. I think if we get nothing else across in this interview, It's that you need to invest while time is on your side.
Yeah. Yeah. And well, for me, there's not a lot of time left. I'm, approaching 70. So, so I'm trying to enjoy life as well. But
I was told once, talking to older investors when I was still a stockbroker, I was told by a gentleman who was in his late 70s, he said, you tell those codgers when they tell you that they don't buy green bananas, that next week they aren't going to have any bananas. The truth is that what's happened to me is when I was young, I was very impatient. It isn't that my time preferences changed. It's just that I've learned that my preferences don't matter at all. I've become more patient because I've learned it takes 5 or 6 years or 10 years, irrespective of how long I thought it might take. What it does take is fairly extended periods of time. So ironically, now that I have time left on Earth, I'm more patient.
Yes, and I am also. Dave Morgan says many times that 80% with like precious metals, 80% of the move comes in the last 20% of the time. And in writing my book, I actually became quite fearful of the economy, and I was rushing to get that book out at the end of last year. I thought that there might be a banking crisis headed for us in like October, November, December timeframe. Well, it didn't happen until March and April.
Right.
And luckily, the book came out a month before the banking crisis. Then on the third day, Amazon changed the listing to a video game from a paperback, and it took 2.5 months to convince them, no, this really is, you can't plug a monitor into this thing.
Right.
It really is a paperback. And so it crushed my sales. But it was interesting. The first book came out like 1 month before the global financial crisis. And this book came out 1 month before Silicon Valley, Silvergate, Signature, First Republic, and Credit Suisse all melted down. And if you look at the way the global financial crisis unfolded, there was a problem with one large bank, and people go, oh, well, that was like an outlier event, and everybody dismisses it. And then 5 months later, there's another problem. I can't remember. I think it was bank runs at Northern Rock in England. Oh, well, that's over in Europe. We don't have to worry about that. And then that was 5 months later. And then 6 months after that is Bear Stearns. And then 2 months later, and then a couple of weeks later, and one day. And so now you've got Lehman and AIG and Fannie Mae and Freddie Mac, and it just went bam, 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 bam. And I really believe that that Silicon Valley, that was just like the first leg down in the unfolding financial catastrophe that awaits us. I'm looking at like the value of real estate measured by Robert Shiller's data, or the real estate price versus average income ratios. And these are they're much higher than 2006 and 7. And I don't have data yet, but we're trying to put together data on the average, like a mortgage payment on $1 million home versus, or the mortgage payment income ratio. That is the really important one, because it's so sensitive and it moves so fast with interest rates. So
I think that is an important thing. It reminds me of driving, I guess it probably would have been late 2006, maybe early 2007, driving the 405 freeway, which you'd be very familiar with, northbound from San Diego.
Yeah.
And as I say, I'm not a real estate guy, but on the right-hand side of the 405, there was a great big billboard, an outdoor advertising thing.
Uh-huh.
And, I've been a lender most of my life. And the billboard said, borrow 125% of the value of your house. Bad credit, okay. It said bad credit, okay. And I remember thinking, I don't think that's going to work out for somebody. There's just something about that billboard that bothers me.
This is that moment where Joe Kennedy says, when the shoe shine boy gives you stock tips, it's time to sell.
Well, I'll tell you, it did bother me. Now, I wasn't,
Yeah.
I wasn't a big real estate investor, and I wasn't a big real estate lender. What I was a shareholder in a couple of banks that were pretty good size in mortgage financing. I wasn't smart enough to go short, but I was smart enough to get that part of my money out of harm's way. The other thing that you said that's really interesting to me has to do with these declines. Buffett has observed that in his life, every 10 or 15 years, something happens, a panic that changes general pricing levels. Both Buffett and Doug Casey, obviously polar opposites in many ways, both of them have observed that bear markets don't make assets worth less. They make them sell for less, and they make them change hands. They go from weak hands to strong hands. Now, the weak hands don't like that a bit, but I think if you conduct your life with the understanding that Buffett has, that every 10 or 15 years, general price levels around investments are going to fall by half. And if you keep some powder dry, and if you try to participate, A, in assets that are out of favor, but B, in assets that are fundamentally mispriced, not assets that are underpriced relative to the expected, means or norms, that while you probably won't do as well as Buffett, that's probably asking more than you should. You will do fine. I remember very well the 2008 bear market because I came into it with a reasonable amount of cash and I'd seen panics before. So I had the tools and I had the courage to pull the trigger. I'm not trying to, I've got them all right, by the way. But 2009 was very, very good to me. And my own suspicion is that sometime in the next 5 years, I'm likely to get another opportunity like that. I hope I don't, but I think I will. That's one of the reasons why I ask people to have cash, despite the fact that the interest that you get paid on your cash is destructive of capital. If you think about the delta between the deposit interest rate that you get paid and the real depreciation of your currency, and you understand that savings actually cost you money, you have to have savings anyway, because that delta really is an option premium on having the liquidity to take advantage of an illiquid market rather than being taken advantage of by that same market. I'm sure you've experienced that in your career.
Yeah. Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video. And, one of the things I just showed at the conference that I was at is from, early in this century, 2001, gold and real estate were rising at about the same percentage rate until 2006, 2007, 2006, real estate. And I'm referring to Dr. Robert Shiller's 20-city index that goes all the way back to the year 1880. So it's an inflation-adjusted index. And then it was real estate and gold were rising together. Real estate leveled off. Gold kept on going. The markets crashed. Gold did a little pullback, but then kept on going. Well, real estate fell by almost half. Now, if it fell by half, that means if you're saving dollars, you could buy twice as much real estate if it fell by half. However, gold doubled. So if you had gone into gold, by the time real estate bottomed and it was half, gold had doubled. And so you could now buy 4 times as much real estate instead of 2. So for me, I have some cash, but typically I am over invested and I don't have much. The dry powder I've got is gold. And one of the interesting things about gold is the liquidity, both to be able to buy and sell it, but also the liquidity if you need to borrow against it. And you're going to be doing gold loans soon, right?
Boy, thank you for that soft pitch. liquidity that you talk about and the value of gold
Yeah.
absolutely as collateral, but also relatively as collateral,
Right.
is truly spectacular. You and I both know a lot of people, you may be one, who have very large amounts of gold, but have occasional needs for liquidity.
Yeah.
And the idea that other banks aren't using highly liquid, high quality, non-correlated collateral like gold on the asset side of their balance sheet, frankly, delights me. That's an enormous market for Battle Bank to go into. It's a market too that's inhabited by people who I know and love and trust. You know, you and I have both been talking to the gold community for many years. And I'm not trying to say that there hasn't been the odd bad apple in our business.
Yeah.
By and large, when I look at the community that I've been able to inhabit, if you call it, if you will, the gold community, the hard money community, very, very, very high quality people. I'm delighted to associate with them. I'm delighted to lend to them.
Yeah.
You know,
I do want to caution anybody out there thinking of taking a gold loan, though. Yeah, typically you can get like 80% loan to asset value, but you are risking a margin call if things fall. And so,
you know,
I mean,
yeah, Mike,
I built a spreadsheet so that I've got a calculator, and if I do temporarily take some cash out against my gold, I look at where I'm going to get margin call, especially silver. It's highly volatile.
Yep.
And so, you want to make sure that you never, I think for anybody out there considering this, I never give advice, but if you're going to go greater than 50% loan to asset value, I would think twice and do some calculations before you do it. During the crash
that's precisely the number we're at, 50% loan to value. We aren't looking to have people over collateralize a collateral package that doesn't generate income. Remember that the gold can't service the loan. The gold can only secure the loan. 50% loan to value serves both the borrower and the lender well. It allows the gold to be used for its stated purpose, which is to say a store of wealth, but an occasional source of liquidity too. So your words are very wise. The community banking business in the United States did well as mortgage lenders when there was a 70 or 75% loan to value on single family residential and duplexes. When we began to get 97% loan to value, we sowed the seeds for what went wrong in 2008. I'm not trying to say it was just a lender's problem. It was a borrower's problem. It was a lender's problem. It was a government problem. But, we took collective leave of our common senses, and I don't want to see gold investors do that.
Right. I was speaking, like I said, to a bunch of real estate investors, and many of them, are constantly pulling out equity and buying more real estate, pulling out equity and buying more real estate. And the thing is, if you pull out some equity and you buy gold, when the gold goes up, when the real estate crashes, and right now, Dr. Robert Shiller says that real estate, the 20-city index, is 125% overvalued. And so it could crash by more than half. This is entirely possible. And that data goes back to 1880. And I first started showing that data in 2004 at the Silver Summit. I've got a video of me. I had a beard back then, presenting Dr. Robert Shiller's index, and nobody had seen this before. This was like brand new information, and saying that there was a massive real estate bubble building. I was cautioning people about real estate, that there was an inevitable crash because all bubbles burst, and people are going, oh, no. Real estate always goes up. It has to. It's never gone down. Real estate always goes up. Well, it did go down. There was a massive real estate bubble in the mid-1920s. It was nationwide, but Florida was the best example. So a lot of people have heard about the Florida real estate bubble. But there's some data available, not a lot, but it was a nationwide bubble, and real estate values did go down, especially in Florida. People got wiped out. The Marx Brothers movie Coconuts was all about that absurd real estate bubble, and it was produced while the stock market was going into a bubble. And Groucho Marx took all of his wealth and then went out on margin and bought stocks on margin in 1928, 29, and got wiped out. He went bankrupt and spent all of the income that he had made on all of those Marx Brothers films, and had to start again from scratch. So
I think a lot of what you describe, I would ascribe to recency bias, which is to say that people's expectation of the future is set by their experience in the immediate rather than the distant past. And I think that many people don't pay enough attention to, if you will, the ground rules, the causes of valuation. They just pay attention to price action, conflating, I suspect, value and price. One anecdote that supports your thesis is very recently I was in Midtown Manhattan visiting offices that are familiar to you, the offices of GBI, Gold Bullion International.
Oh, yes.
Prime Midtown East Side real estate, second tier office building. Probably
50% occupancy at this point.
16% occupied.
Whoa.
The building, I don't know much about operating commercial real estate, but I don't suspect that the building can cover operating expenses, much less a margin, much less interest on a mortgage. Now, maybe that's just one office. I haven't done a statistical survey of B-class office buildings in Midtown Manhattan, but the idea that this building is less than 20% occupied.
Yeah.
How would you feel if you were that mortgage holder?
Pretty panicked, unless the owner's balance sheet did include something like gold, where it had doubled or tripled during that period of time. Now, I was looking for it just now, and I don't see it anywhere. But there was on Twitter or X a comment about it. It showed this office building in New York City that had sold, I think, in 2018 or 19 for $65 million, and it just sold again for $16 million.
Right.
And it's because of this commercial real estate occupancy crisis. And when that crisis meets refinance so you've got that low occupancy, and most viewers here probably don't understand that the value of a commercial building isn't based on it helps to have a good location. It helps to have a nice structure, but the value is really the rents that are coming from it. So the occupancy determines the value of the building. If they've already got a mortgage on the building, and that mortgage is coming up, and they've got to roll over this mortgage at the new higher rates, because the rates have gone astronomical from where they were, and the building is only 50% occupied. Well, that means the building lost a tremendous amount of value, and it may be underwater right now compared to that loan. And so they can't get the refinancing. So they either have to come up with all the cash difference, or they've got to sell the building. And that is the reason we have a $65 million building selling for 16. Nobody wants to buy them when they're not occupied. There's no cash flow.
Right. It's important to understand, as you correctly pointed out, that building, if you think of it from a mortgage holder's point of view, is a brick and mortar bond. If there isn't any coupon, that bond, irrespective of whether or not the brick and mortar is tastefully arrayed, isn't going to carry the value of the building.
That's a very interesting analogy. Yeah.
One of the, I think about me based on our last interview, that I'm really, over time, a perpetual optimist. I have looked at our country and, in fact, looked at the world, and I've marveled at our collective stupidity. I used to joke that Doug Casey and I, between us, have correctly forecasted 17 of the last 3 recessions.
Yep.
I believe that humankind, absent nuclear war, will be in better shape 10 years from now than it is today.
Yes, but I think we have to get through this next 10 years. We're at a very dangerous moment in history. If we don't develop a virus that wipes us all out, or have nuclear war, there's so many ifs. But we've got the brightest future ahead of us, a world of superabundance, and it's almost free energy, it's all going to change. Artificial intelligence and robotics is going to make everything so different. Than there's going to be more change over the next 10 years than there has been in the last 2,000.
So I think it's incumbent on your listeners to prepare themselves for that change, so that they come out the backside with as little trauma as they want, or pardon me, as they can affect. The reason I said that is because the next thing I want to talk about is pretty gloomy, and I don't want people to use all of the negative circumstances that confront us to do nothing. I don't want people to curl up in fetal condition in the corner.
You have to take action, right?
I want people to prepare themselves. The thing, when I look out there, that scares me the most, well, our credit markets generally, but that includes corporate credits. We may have talked about this before, Mike, but there's a whole group of retail yield chasers, inelegantly termed yield whores, by the way. And many of these people express their desire for high yields in the junk bond ETFs. That is, ETFs that are made up of below investment grade credits.
Mm-hmm.
And what scares me about this is that the top structures, the ETFs, are extraordinarily liquid. But they own instruments, junk bonds, many of which trade over the counter, are unlisted, that are extremely unliquid.
Mm-hmm.
And if you have a situation like 2008, where there becomes broad spread concern among the populace about credit quality, and people go to sell the topco, the ETF, the ETF manager has to sell the underlying bonds in a market where he or she can't do that.
And as we discovered in 2008, they can go to zero.
And it's
zero.
A multi-trillion-dollar asset class with an unbelievable mismatch in liquidity. I may have used this quip before, but I remember when the junk bond blow up happened around 2000, there was a joke about something called owl bonds. Mm-hmm. An owl bond is where you called your broker and said sell, and your broker said, to who? To who? And my nervousness around these junk bonds and these ETFs is that, like when the money market funds blew up in 2008, you're going to have a situation where the ETFs can't sell the underlying securities fast enough to handle redemptions. And I think the ripples through the entire credit market, the real estate credit market, and every other credit market. I'm not saying this is going to happen, but when I look at what the things are that really, truly keep me awake at night, that's certainly at the top of the list for me.
Yeah. From my book, many of those junk bonds that you're talking about were issued by these companies here. This is zombie companies that can't afford to pay the interest on their debt, just the interest, not the principal. And it's gone from, in the year 2000, it was down at 3%, and it's up at 20% now. That's 1 in 5 publicly listed companies. This is scary as can be. I just can't imagine driving down a main street in a city, like, driving through New York or downtown Los Angeles and seeing 1 out of every 5 stores boarded up. And this doesn't just include retailers. This would be, manufacturers and all sorts of sectors. And so I just think we're at a very dangerous moment in history now. But yes, we have this incredibly bright future ahead of us. We just have to get through the next 10 years. And in every crisis, there is an opportunity, and it's the viewer's job to find it and learn as much as you can about it. So,
well, that's absolutely correct.
Yeah. Okay. I want to thank you so much. We're at about almost 40 minutes now. So we'll do this again in a few weeks. So,
Mike, I always enjoy these conversations. I look forward someday, somewhere, to doing one in person.
Yes, that would be great. Just sitting down and having a chat. That would be wonderful. So I want to remind everybody, please like and subscribe. And if you can, if you got anything from this, just email the link to a friend. So thanks, Rick.
But Mike, before I go, any of your listeners who would like my opinion about their natural resource portfolio, that old offer is still good. If you go to ruralinvestmentmedia.com and list your natural resource stocks, I will, for free, no obligation, rank them 1 to 10, 1 being best, 10 being worst. I'll comment too on individual issues if I think my comments might be of any value at all. I've enjoyed the interaction that I've had with your listeners over the years, and I look forward to many more in the future.
Okay. Well, thanks. And to all of the viewers out there, we'll see you in the next video. Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 111. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win.